Most traders will never figure out why they keep losing. Not because the market is too complex, not because they lack intelligence, but because they are looking for the answer in the wrong place. They keep changing strategies, buying courses, watching more videos, adding more indicators to their charts, and the losses continue. If that sounds like you, stay right here, because what I am about to show you is the one thing sitting between where you are now and where you are trying to go. Most people call it the skill gap. I call it the death zone, and 90% of traders never make it out. I want you to picture a scale. On one side, you have a trader who knows everything, knows market structure, knows liquidity, knows how to read order flow, has watched hundreds of hours of content. On the other side, you have a trader who makes money every single month without blowing accounts, without emotional spirals, without needing to study any more strategies. Now here is the uncomfortable truth. Those are not the same person. Knowing and doing are two completely different skills, and the space between them is exactly where most trading careers come to an end. Think about that for a second. You probably already know what a good setup looks like. You probably know you should not revenge trade. You probably know you should respect your stop loss and not move it when price gets close. You know all of that. So why is the account still going down? That question is not rhetorical. The answer to that question is the entire point of this video. And by the time this is over, you are going to see your trading from a completely different angle. Here is something no one talks about honestly enough. The market does not care about your knowledge at all. You can pass every trading exam ever written, memorize every candlestick pattern, understand every institutional concept, and the market will still take your money if your behavior is broken. The market is a machine that extracts money from people with poor discipline and redistributes it to people with strong process. That is the entire game. And the gap between losing and winning is almost never about strategy. It is almost always about behavior. I've studied this pattern for years. Not just my own trading, but the trading of hundreds of people who have gone through the same cycle. Win a little, lose it all, start over, find a new strategy, repeat. The ones who eventually broke out of that cycle all had one thing in common. They stopped chasing better strategies and started fixing their behavior. Every single one of them, without exception. That pattern is too consistent to be a coincidence. And that is exactly what we are going to break down today. Here is how to understand the gap in the simplest possible way. There are 3 floors to this building. Floor 1 is knowledge. That is your understanding of how markets move, where price is likely to go, and what a valid setup looks like. Most traders live here and think this is the whole building. Floor 2 is execution. That is your ability to take the trade when the setup is actually there, manage it without panic, and exit according to your plan. Floor 3 is consistency. That is your ability to do floor 2 the same way over and over, regardless of what your last 5 trades look like. Profitable traders operate on floor 3. Most struggling traders never make it past floor 1. Let us go straight to floor 2, because this is where the real bleeding happens. You are watching the chart. A setup forms. Everything you have ever studied tells you this is valid. Structure is aligned. You have confluence. The entry is clean. And then your brain does something absolutely predictable. It starts generating doubt. What if this one fails like the last one? What if I am reading this wrong? What if I enter and it immediately reverses? So you wait. You ask for one more confirmation. And while you are waiting, the trade moves without you. You watch 60 pips print in the exact direction you predicted, and you feel sick. That moment right there is the gap eating your money in real time. What just happened in that moment is not weakness. It is biology. Your brain is running a protection program that was built over thousands of years of human evolution. The same instinct that kept your ancestors from walking into a lion's den is the same instinct that stops you from clicking the buy button. The brain experiences financial loss almost identically to physical pain, so it avoids the risk even when the risk is calculated and logical. This is called loss aversion, and it is the invisible hand that is quietly destroying your trading account every single week. Here is a scenario I want you to sit with. Trader A sees a textbook setup, bearish market structure on the higher time frame, a liquidity grab above the previous high, price is now rejecting from a clean order block, risk to reward is sitting at 1 to 3, everything is there. But Trader A just came off 2 consecutive losses yesterday, so the doubt kicks in. They decide to wait for one more confirmation. Price drops 3 candles. They chase the entry, get caught in the retracement, stopped out. Then watch the original entry play out for exactly what they predicted. Tell me honestly, have you lived that trade before? Now watch what Trader B does in the exact same situation. Same setup, same 2 losses from yesterday, but Trader B does not carry yesterday into today. They look at the setup and ask exactly one question. Does this meet meet every single one of my entry rules? The answer is yes. They enter. They set the stop at the logical structural level. They walk away from the screen, not because they are emotionless, not because they do not care, but because they have trained themselves to separate process from outcome. That separation is a skill, and it is a learnable one. So how do you build that skill? It starts with making your rules so specific that there is zero room for interpretation in the moment, not rules written loosely on paper. Rules so clear and defined that a complete stranger could look at your chart and tell you whether the setup qualifies or not. If your rules have any gray area, your brain will exploit that gray area every single time you are under emotional pressure. Vague rules create vague execution. Vague execution creates random results, and random results destroy confidence, which is the exact fuel you need to close the gap. Write your rules down right now if you have not already. Entry conditions, confirmation requirements, stop placement logic, target logic, position sizing formula, all of it written so clearly you could hand it to someone else and they could trade your system. If you cannot do that today, that is your homework before your next trade. Because trading from unclear rules is like trying to build a house from a blueprint that has half the measurements missing. You will always end up with something crooked. Now let us get to floor 3, because this one is where most people completely fall apart right when they think they are finally getting somewhere. Consistency is not about performing well during a good week. Any trader can do that. Consistency is about your behavior not changing when you hit a rough patch. It means your lot size does not balloon after 3 winners because you feel untouchable. It means you do not abandon your setup criteria after 3 losers because you feel like nothing is working. It means Tuesday after a rough Monday looks exactly the same in terms of how you approach the chart. That level of behavioral stability is what separates real traders from traders who just get lucky in cycles. Here is the trap inside consistency that very few people name directly. It is called outcome-based evaluation. This is when you judge whether your trading decisions were good or bad based on whether the trade won or lost. A trader takes a perfect setup that follows every rule they have. It loses. They conclude the strategy is broken. Another trader ignores their rules, enters on impulse, and the trade randomly wins. They feel like a genius. Both of those traders are completely disconnected from reality, because in trading, a disciplined loss is a good trade, and an undisciplined win is a dangerous trade. The win teaches you nothing. The disciplined loss builds your edge. This is exactly why a trade journal done properly is one of the most powerful tools in existence for a developing trader. Not a spreadsheet of results, a real journal that captures your mental state before the session, your reasoning at entry, whether you followed your checklist, what you felt during the trade, and what you would do differently in hindsight. Done honestly over 30 to 60 days, that journal will show you behavioral patterns that you cannot see in the moment. It will show you that you consistently overtrade on Fridays, that your worst trades happen after big winners, that you cut profits short every time you are up more than 30 pips. Those patterns are your personal roadmap out of the gap, and you will never find them without the mirror of a real journal. Here is a simple journaling structure that actually produces results. Before every session, write your mindset score from 1 to 10 and one sentence about what you are bringing into the session emotionally. After every trade, write whether the entry was rule compliant, what the emotional experience was during the trade, and one thing to reinforce or correct going forward. That is it. Simple. But if you do it without skipping for 30 days, what you discover about your own patterns will be worth more than any strategy you could ever buy. Let us talk about the knowledge layer now, because there is a specific problem here that almost no one addresses honestly. Most struggling traders do not have a knowledge problem. They have a knowledge overload problem. They know ICT concepts. They know Wyckoff. They know supply and demand. They know harmonic patterns. They know everything. And when they sit in front of a live chart, all of that knowledge creates internal conflict. One framework says go long. Another says wait for a retest. Another says the whole structure is bearish. That conflict does not make you a better analyst. It makes you paralyzed at the exact moment you need to be decisive. The solution to this is counterintuitive for most traders. You need to learn less and execute more. Pick one strategy, one that has a clear, testable, logical edge. Trade nothing else for 90 days. No new concepts, no new videos about different methodologies, just that one system, traded with full commitment. This is called strategic narrowing, and it is the phase that almost every consistently profitable trader went through before they found their rhythm. The goal is not to know everything. The goal is to know one thing so well that executing it becomes automatic. Automation is where the money lives. Now let us talk about the emotional traps that are actively holding you in the gap right now, because you need to know these by name. The first one is recency bias. Your last 3 trades have way too much influence over your next decision. 3 losses in a row, and suddenly your strategy is broken. 2 wins in a row, and suddenly you double your size. Both reactions are irrational because 3 trades is not a sample size. It is noise. You need at least 100 trades to even begin evaluating whether your edge is real. Judging your strategy on 3 trades is like judging a restaurant after trying 1 dish. The second trap is confirmation bias. This is when you have already decided what you want the market to do, and you selectively read the chart to support that decision. You want to buy so every bullish signal looks significant and every bearish signal gets ignored. This one is especially dangerous because it mimics analysis. It looks like you are being thorough, but you are just building a case for what you already believe. Real analysis means actively looking for reasons not to take the trade. If after genuinely searching you cannot find a reason to stay out, then you have a valid trade. But if you are filtering out inconvenient signals, you are rationalizing, not analyzing. The third trap is FOMO, and it is the one that consistently turns disciplined traders into gamblers in a single moment. Price has moved significantly. You missed the original entry, but you watch it go, and the discomfort of not being in the trade becomes unbearable. So you chase. You enter late with a terrible risk to reward, a stop that is too far away, and a target that is already half reached. And deep down you know this is a bad trade as you are placing it. But the feeling of watching without participating overrides everything you know. That discomfort is not a trading signal. It is an emotional signal. And following emotional signals is how accounts get destroyed in real time. The weapon against all 3 of these traps is a pre-trade checklist, and you need to treat it like a non-negotiable procedure. 5 questions before every single trade. Does this setup meet every one of my entry criteria with no exceptions? Is my stop placed at a logical structural level rather than a convenient number? Is my risk to reward a minimum of 1 to 2? Am I entering from a planned level, or am I chasing a move that already happened? Am I in the right emotional state to trade this right now? If any answer is no, the trade does not happen. No overrides, no exceptions. That checklist is the buffer between impulse and action, and that buffer is worth more than any indicator you will ever find. Here is something the trading industry almost never talks about because it is uncomfortable. The gap is not only psychological, it is structural. Your trading environment itself might be working against everything you are trying to build. If you are trading with money you genuinely cannot afford to lose, your nervous system will be in threat mode before the session even starts. Every decision will be made under survival pressure. That pressure destroys objectivity. If you are staring at the screen for 6 hours watching every tick, you will overtrade. The longer you sit in front of a live chart with nothing to do, the more your brain manufactures reasons to place trades that do not exist. That is not discipline failure. That is an environmental design failure. Build your environment around your edge. Trade only the sessions where your specific setups have the most historical validity. For most strategies, that is the London Open or the New York Open, when volume is real and price moves with purpose. Outside of those windows, close the chart. Literally close it. Set your trade, place your stop, write your journal entry, and remove yourself from the screen. Watching a trade after entry does not improve the outcome. It only gives your nervous system more opportunities to make fear-based decisions that override your original logic. Now let us connect every single piece of this directly to money, because that is the whole point. Every valid setup you fail to take is not just a missed trade. It is a missed data point in building your track record. Your track record is your confidence foundation. Confidence built on a real track record is what eventually allows you to increase position size in a way that feels rational rather than reckless. Increased position size applied to a proven edge is how modest, consistent gains become life-changing income over time. That entire progression depends on one thing: executing your edge with discipline from the very beginning. You cannot jump to step 5 without walking through steps 1 through 4. And here is the compounding effect of bad behavior that no one likes to talk about. Every time you break a rule and survive, your brain logs that as evidence that breaking rules is acceptable. Do that enough times, and you have trained yourself into permanent inconsistency. The brain learns through repetition, whether the repetition is good or bad. Bad habits compound at the exact same rate as good ones. This means every undisciplined trade you take today is not just costing you the money lost. It is making the next undisciplined trade more likely. That is a cycle you can only break through deliberate, conscious behavior change starting right now. Here is the financial reality push. put plainly. A strategy that wins 45% of the time with a 1 to 2 risk to reward ratio is mathematically profitable over a large sample. The numbers work, but they only work if you take every valid setup, follow every rule, and do not deviate when it gets emotionally uncomfortable. A trader using that same exact strategy, who skips entries out of fear, holds losers hoping for a recovery, cuts winners early because they are nervous, and increases size after hot streaks, will lose money with a profitable system. The edge is not in the strategy. The edge is in the execution of the strategy. That is the whole game in one sentence. So here's exactly what to do starting with your very next session. Pick one strategy and commit to trading only that strategy for 90 days without introducing anything new. Build a pre-trade checklist and refuse to place any trade that does not clear every item on that list. Start a real behavioral journal, not a results spreadsheet, and use it every single session without exception. Fix your trading environment by trading only your highest probability sessions and removing yourself from the screen after entry. And most importantly, begin measuring your performance by rule adherence rather than profit and loss. A disciplined loss is a win for your process. An undisciplined win is a loss for your development. Learn to see it that way and everything starts to shift. The traders on the profitable side of the gap are not a different species. They are not smarter. They did not find a secret strategy that you have not seen yet. They just did the unglamorous work of closing the gap. They identified their execution failures one by one and fixed them. They built structure around their behavior. They repeated the right actions until consistency stopped being an effort and became a default. That process is not locked behind a paywall. It is not reserved for a certain type of person. It is available to every trader willing to stop looking for shortcuts and start doing the real work. If this video showed you something you needed to hear, hit the like button right now because it helps this content reach the traders who are stuck in the same cycle and do not know why. Subscribe if you are serious about building something that actually lasts in trading. And do not go anywhere because the next video covers something that will catch most of you completely off guard. It is about what happens to your psychology the moment you start trading well. Because the truth is, your first real winning streak might be the most dangerous period of your entire trading career. That video is next. You need to see it before it happens to you.